So welcome, Dan. Thank you so much for making time. I know it's pretty late for you back in Singapore, and I hope you had a wonderful evening. And I'm sorry I'm making you sleep 1 hour less tonight,
No,
but I hope you can sleep
that's
1 more hour tomorrow. And I'm very appreciative of you taking time and talking about ethics and AI, two of your favorite topics. So Dan and we interacted late last year, and then we kind of continued our conversation. And I know Dan has been very active in terms of operationalizing machine learning and artificial intelligence, and his company Lightbulb Capital is also influencing some of the thought leadership in the way AI and machine learning should be used in the financial services industry. So we thought we'll spend a little bit of time today to talk about what does it mean to bring about AI and machine learning, and also looking at the whole notion of fintech, which Dan is heavily involved with a lot of cryptocurrencies and a lot of action happening in the space. And he's fortunate to be in Singapore, which has also pioneered some of the initiatives in responsible AI, and has been one of the few countries which have taken it on their responsibility to kind of make sure that not only that policy and thought leadership comes from companies, but also from a government perspective, how to influence that thought process. So without further ado, we'll go ahead. And before we get there, I'm just going to make some quick remarks on today's presentation. Give me 1 second. Let me just share my slides. Okay, just a second. I think I'm sharing the right slides. Okay, so what we're going to do is like into what Quant University is about. Can you hear me okay, Dan?
yeah, loud and clear.
Perfect. So Quant University, we started out at the intersection of data science, machine learning, and quantitative finance. And we do a lot of educational workshops. And the Quant University Fall School, we are in the middle of the Quant University Fall School. We have 3 courses which people from more than 13 different countries are taking. We have a course on data science, machine learning, and quantitative finance. And we also have a course running on model risk management and how do we apply model risk management principles for machine learning models. And we also have a fintech course going on, and all these are a part of the autumn school. And we have been fortunate to have people like Dan and many other thought leaders to come down and talk about their experiences and how they're seeing the world from operationalizing many of these methods in their own companies. So we are also planning the winter school, and we are expanding the portfolio of course offerings in the winter school. So if you're interested, go to qwinterschool.splashthat.com, and we will be able to share some more information as we kind of put together the various speakers and also the various courses we're going to be offering. So without further ado, I'd like to welcome our speaker for today or tonight, Dan. So Dan is from Lightbulb Capital. And I found about his work when he published a chapter in the book, the AI book. It's a wonderful book. I would highly recommend you to take a look at the book. And Dan, I have a very similar background to Dan, let's say, because he started out as someone who is analytical, and he kind of was bringing in various aspects of engineering and technology, but then he's kind of moved into finance, and he's worked with a lot of different companies. And he also is a faculty member at the Singapore Management University, teaching various courses in finance, fintech, blockchain, digital assets, etc. So in case, Dan, if I'm not teaching, you're going to be teaching some of my classes because you have a very similar background as me. And he's also a PhD candidate at the Rotterdam School of Management. and he's researching various topics in blockchain and AI. And he also has traveled the world. He lives in Singapore now, but he's also studied in Madrid, and he's originally from Germany, if I'm correct, right?
Yeah, that's correct.
And a couple of other quick announcements. So Steven Jensen, who's also from Germany, incidentally, so he's going to be presenting next week, and he's going to be talking about his book on algorithmic trading, and he's going to talk about some examples on synthetic data generation in finance. So without further ado, I will transfer the host privileges to you, Dan, and please share your screen, and we can go ahead.
Okay, let's see. Let's see. Can you see my slides?
Yes, you can.
Excellent. Okay. All right, sweet. So thank you very much for hosting me. It's a real pleasure. Even though it's a little bit late at night, I had to turn on sorts of artificial lights to make sure that you guys can see me. But it's a real pleasure to be able to talk about one of my favorite topics, which is the ethical use of AI in financial markets. And I know that we don't have a whole lot of time because I could speak to you about this for very long. But basically what we're going to do today is talk briefly about AI and ML in markets, like a little history lesson, okay? That's how I like to start out. And then really dive into who needs to control who, you know? Is it the machine, the man, the machine? Some views on what governments are doing in this space, but then also the main portion of the presentation is really about some of the principles and how to operationalize them in financial markets. We'll talk about things like fairness, privacy, transparency, explainability, also accountability. And then we can wrap up and perhaps spend a little bit of time on Q&A if you guys want to. So at any point in time, throw me questions, but we'll have an extra section at the end for you to ask questions. Okay, so let's get started. I think we can skip over this. The one thing I would say is the book chapter that she just mentioned, I wrote together with my co-author, Tiffany Wong. She's actually now moved. I should update this slide. She's now with Revolut, working on how to use AI in the context of KYC and fraud risk and so on. Just to make sure we're all on the same page, I like to start with the definition of what machine learning is. And this is very important because sometimes people misunderstand a little bit. So what is machine learning? Is really all about systems having an ability to automatically learn and improve from experience without being explicitly programmed, right? And if you think about that in the context of financial markets, that means that it's not algorithmic trading, because algorithmic trading has been there for a very long time. I remember in my early career days in 1999, there's probably already algorithmic trading, but it's rule-based, right? It's more like an expert system. Similarly, high frequency trading has been around for a long while. And while some high frequency trading shops might also use machine learning, the pure definition of high frequency trading is all about connectivity and speed. And that could still be static, right? So it's nothing about the ability to learn from the data that an algorithm sees, just to kind of make sure we're all on the same page. Okay. Skip over that. Now, this is a very interesting slide. I don't know whether you've seen it, but basically talks about the amount of data in the world, and then it also talks about unstructured and structured data, right? And if you look at this little graph, I think it's just two interesting observations. So about 5 years ago, for the first time, there was more structured data. Think of structured data as something that a computer can process. More structured data than unstructured data in the world. And then from there on, right, it just exploded exponentially. And then as you can see, the blue line kind of deteriorates towards 2020. I'm not sure, this slide is a little bit older. I'm not sure how that actually developed, but you can, you look at the world, you could clearly see that computers can process massive amounts of data. So that makes you think a little bit, right? If there are two fund managers and they're both equally good. What I mean by that is they have excellent client base all over the world. They have excellent research. They have good portfolio managers. Everything's the same, but one company can leverage machine learning and the other one can't, right? One can derive insights from data, the other one can't. Which one is going to succeed, right? It's clearly the one that can make sense of all of this additional data that is out there right now. So that's just one thing that I wanted to kind of kick off this session with. Now, talk about 5 milestones for the use of AI in financial markets. And we'll start with this gentleman. I don't know whether you've seen him, probably if you're in the space, yes. And then you've also read the book by Greg, wonderful book, by the way. As early as 1982, there were people applying machine learning techniques to derive insights from markets, right? And this is fascinating because in 1982, we didn't have cloud computing, we didn't have powerful computers like we have today. But yet people were starting to explore how to use some of these machine learning concepts that we also find today, in basic Python libraries. They tried to use them back then, and very, very successfully. So yeah, I don't know. I haven't looked up Jim Simmons' net worth really, but I think it's quite massive. What happened next? Well, next thing that happened is really the advent of alternative data, right? So the most prominent example, I'm sure you know, is all about understanding the sales of Walmart by people looking at the satellite image of the car park in front of the Walmart, right? But there are lots and lots more data sets and companies that specialize in using alternative data to interact with the markets. One very interesting company that is actually based here in Singapore called Bluefire AI, that basically scrapes information from Chinese blogs, because as we all know, lots of information in Chinese equities is not integrated in the price. Yeah, it's a very retail-based market. So they scrape all this information, and then basically they create a risk matrix on the back of that alternative data to help people in the fund management industry to understand risks that are associated to different companies. Yeah? So alternative data and just new data on top of the traditional data, which basically in the past, right, consisted of fundamental data, financial reports and so on, and then also price data. Right? The traditional. Now, the third thing that happened is really actually a person. Marcos Lopez de Prado happened, right? A thought leader in the world of machine learning and in finance. He's contributed a lot in terms of creating guidance on how to use machine learning in financial markets properly, because there are many mistakes that we can make. Think about overfitting problems, for example. He's developed a whole bunch of things, including the deflated or probabilistic Sharpe ratio to measure performance when people backtest and address this multiple testing problem. So that was in itself something that really pushed, I think, machine learning in finance forward quite a bit. Now, number 4, a paper. You don't have to read the whole paper, but if you're interested in the topic and you don't know the paper, maybe it's a good idea, actually. Why is this paper so important? It's called Empirical Asset Pricing via Machine Learning. This paper is very important because the key finding behind it is that it empirically shows that fund managers that use machine learning can understand expected returns better than the ones who don't. So that begs the question, what are fund managers doing that don't use machine learning, right? So that's a really meaningful insight that we should all think about for a moment. Yeah. Okay, number 5 and the last one, I believe. I think is amazing. FDP Institute showed up, right? Kaya Institute launched a certification that basically helps people study and understand how to apply some of these machine learning and data science techniques. Very similar to the CFA program, where you basically study on your own. You don't get the luxury of Quant University, where people present information to you, and then you can basically learn about these topics and also learn how to use Python, for example. So I think that's an important step alongside, for example, Quant University, to make sure that the broader group of financial services professionals can learn about machine learning and how to use it. All right, that's my quick introduction. Last 30 years in summary in terms of machine learning and finance. Now let's talk a little bit about ethics, right? Which is kind of the main topic of today's session. And some people argue, isn't ethics in financial markets a bit of an oxymoron, AI or no AI? And maybe this issue around ethics is as old as the financial markets themselves. I don't know whether any of you had the opportunity to watch the movie that I'm showing here, The Hummingbird Project, but it's actually quite a good movie, especially if you're in the industry. It talks about two brothers that leave a hedge fund to build a connection between a rural exchange in the US and I think the New York Stock Exchange. And the idea is just to conduct basically arbitrage between those two exchanges by being faster, right? Faster than everyone else by using this line. And the movie is called Hummingbird Project. Why? Because it takes a hummingbird 1 microsecond to flap. And that line gives this team the advantage of 1 second, right? Being 1 microsecond faster. So, it begs the question, is that fair, right? Is it fair to be faster than everyone else? Is it unfair? Something to think about. Now, as Sri mentioned earlier, I'm quoting most of the content in this presentation from a book chapter that we wrote about AI and business ethics in markets. And I want to start this conversation with a quote from a financial markets professional that now is a partner in a macro hedge fund, and that in the past used to run the global markets business in HSBC. That's where we met. He was my boss. And when I asked him about AI and ethics in markets, this is his statement. Humans have found it impossible to encode ethical standards in finance. So we generally get principle-based guidance like do the right thing. It will take AI a long time to learn the difference between right and wrong on matters where human experts often disagree. So in summary, what is he saying here? He's saying, we can't even figure out ethics ourselves. How a machine's gonna ever be able to do it? No way. So that's an interesting perspective, right? Then quote number 2. Quote number 2 comes from Marcos. We already spoke about him. He says, financial transactions are fraught with agency problems. One solution is to replace human judgment with smart, systematic processes. Another solution is to deploy algorithms that monitor human decisions in search for biases. In both cases, AI has an important role to play. Now, how interesting is that? Both of these gentlemen are very experienced financial markets professionals. And one says, no way, machines are not going to be able to be ethical anytime soon. And what Marcos is saying is like, we already have so many problems, so many ethical issues in the markets. As a matter of fact, if we don't start using machine learning, we're screwed, right? We will not be able to solve these agency issues that exist today without the use of machine learning. So when we got these 2 quotes, Tiffany and I, we thought that's awesome, right? Because when experts disagree, then there's a book chapter to be written. So that's what we try to do. Now, let's talk a little bit about how governments look at these topics. Does it even matter, right? AI ethics at first sounds like a very esoteric kind of a topic, but actually it's not. It's a real problem. And that's why you can see that around the world, there are regulators that are trying to figure out how to give guidance to the industry, right? Whether it's in Hong Kong, there's a framework. We have one in Europe. I'm quoting 2 documents here that the Singapore government has put out. So it's really a global conversation that's happening around AI ethics at the moment. Something that all of these documents share is that they are principle-based. What's the issue with principles? I believe the issue with principles is that they're sometimes not so tangible, right? If I would say, fairness is a principle, make sure that you treat people fair. Everyone thinks at first about, not disadvantaging anyone when they, I don't know, sell products or something like that, right? Amazon recommender systems type of a setting. But then what does it actually mean for financial markets, right? It's a very different setting. So that's what got us a little bit interested in looking at this whole topic purely through a financial markets lens. Believe it or not, even China, some of us believe that in China, data privacy and so on is all not up to grabs. But even in China, there's a document called the Beijing AI Principles, which basically does the same thing as every other regulator in the world. Basically tries to make sure that there is some sort of framework to use AI in an ethical fashion. Okay, so what we're going to do now is zoom in a little bit on financial markets. And as I mentioned before, there are these 5 principles that I want to discuss. And what I want to focus on is basically try to operationalize some of these principles, right? And make sure that we give tangible examples on what some of these principles actually means on a trading floor, okay? Okay, so first one, fairness. What's fairness? Just for the record, treating stakeholders impartially and just without taking unfair advantage of them is basically the definition, right? There's nothing new. As we said earlier, it's perhaps as old as financial markets itself, this whole fairness issue. What's the problem with fairness in the context of machine learning? Well, if you're familiar with reinforcement learning algorithms, they basically keep a little account on how well they're doing, right? And they are trying to optimize to increase little points that they get in their account. So if they take a good decision, they get a point. That's how is the easier way to think about it. If they take a good decision, they get a point. If they make a bad decision, 1 point gets subtracted. So that's great for financial markets, actually works really well. But here's the issue. What happens if this reinforcement learning algorithm realizes that the best possible way to get as many points as possible is to basically use, unfair practices? Actually, practices that probably, if a human conducted them, would be fraud, right? Would be securities fraud. Think of things like spoofing or wash trading, or I don't know, some sort of pump and dump scheme. So there's a real problem there, right? What do you do with this reinforcement algorithm to make sure it doesn't have to go to jail? We'll talk about whether that's possible or not later. But basically what we're saying is we have to give these algorithms some sort of boundaries to delineate fair and unfair activity from each other, right? If we don't do that and they're allowed to do whatever to optimize and reach their goal to accumulate as many points as possible, then that might be an issue. It's interesting, right? Some people argue, well, algorithms need to be overseen in a lot more strict fashion than humans. But I disagree with that actually, because I think it doesn't really help to foster innovation. What I am advocating is actually that whatever regulation we use and we apply to human traders, we should also apply to algorithms, right? And then I think we have a good base to start off from. So that's fairness. Let's see what else is there. Privacy. Privacy is a big topic. What's it defined as? Someone's right to keep their personal matters and relationships private or secret. And you can clearly see how the centralized nature of today's financial markets pose a bit of an issue here, right? This is actually true. You can believe it or not true, but we wrote this chapter before the Hong Kong Stock Exchange got hacked last year. And it's interesting because the Hong Kong Monetary Authority mentioned in a report the previous year that the amount of cyber incidents towards financial institutions in Hong Kong had spiked, right, for some reason. So it's very easy to imagine how these cyber criminals will basically use machine learning to exploit some of the data that they get access to when they conduct their cyber attacks, right? So think about some information that is perhaps related to ultimate beneficial owners of some member firm on a stock exchange. If that data, that data often is data that needs to be disclosed in an orderly fashion. If that gets out and somebody hears about it before everyone else, then there's an unfair situation where people can take advantage, right? What's the solution here? The solution actually comes from the cryptography world, and it's called zero knowledge proofs. And just for those of you who perhaps haven't heard the concept, is a very exciting concept that is most easily explained by using this example of somebody going to see an adult movie, right? Let's just say I want to go to the adult movie, and I go to the counter and then I pay. And then what happens next? Probably the cashier is going to ask me for my ID, right? And then I don't know, where's my ID? Here's my ID. Show you my ID. Also not very safe, huh? From a privacy perspective. This is my ID. And what information does it have actually? It talks about my name, my company, some unique identifier, my sex, my birth date, my nationality, whole bunch of data points on this ID, right? The cashier will see all of this. Actually, what they do need to see, what is that? What would you say would they need to see? My date of birth, right? But I argue actually they don't need to see my date of birth. All they need is a confirmation that I am older than 18 or 21, depending on the jurisdiction, right? So that's where zero knowledge proofs comes in. With zero knowledge proofs, a inquirer can quiz a data set to get a yes/no answer based on some data that is basically stored with me as an individual. So if in this movie case, right, the cashier would ask, is Daniel above 21 years old? Then it would get a yes answer based on my date, which is, in the late 70s. Shall not disclose the exact date. And that's really interesting, right? Because it does make sure that we don't have to store all of this data centrally that can get hacked. Individual companies could store their data, and then if somebody wanted to query or wanted to quiz or needed to know about certain data points, they could ask these yes/no questions and have probabilistic proof that somebody is above 21, for example. So that's my take on privacy. Let's talk a little bit about transparency next. So transparency, also very, very important aspect in financial markets. What is it? Is the quality of making something obvious or easy to understand. Obvious or easy to understand. And in our context, machine learning in finance basically refers to whether the public's view of what AI can and cannot do is actually aligned with reality, or is true. So what's the problem here? The problem is that basically there's actually a multitude of issues around understanding what machine learning can and cannot do. And in the book chapter, we use this Hong Kong-based fund where an investor had put down $20 million and then lost them, and then went back to the fund manager and said, how is that even possible? Your salesperson explained to me that you have an AI, and then now you're telling me you're losing $20 million? I don't understand. How's that possible? So I think a couple of things went wrong here, right? The first one is the salesperson probably overpitched what this machine learning algorithm could do for investors. So that's no good, right? That's not very transparent. We don't know how that case settled, or if it already settled, but I know that it was at court. And what we do know, though, is that there's a bit of an expectation gap, right, between what perhaps people think machine learning can do and what it can actually do. And why is that this gap? Well, number one, because the salesperson probably spoke too positively about their algorithm, but also because some people that invest in machine learning based algorithms might not fully or might not understand what machine learning can and cannot do to begin with. So how can we address this issue? So I think there need to be two things happening to improve the situation. Number one is we basically need to make sure that there's lots more disclosure, right? Mandatory disclosure on how these machine learning algorithms function and how they react to different types of scenarios and different types of markets movements. And the other thing that I think is very interesting is if you think back, I think this started probably in the 90s or something, exchanges educated retail investors on how derivatives work. I don't know whether you've ever been to one of those workshops, but your local exchange probably has that in store for you, right? If you really want to know what is a long call and a put and a straddle, you can probably go to your exchange and learn. And why is that so? Well, because markets want market participants, and market participants are not allowed to trade derivatives unless they show some sort of proficiency in them. And I think we can use a similar concept in the context of financial markets and just say, look, if you want to invest in something that uses machine learning, then you have to get what the basics are of this new technology so that you can understand the risks better, similar to the derivatives example that I just quoted. So I'm really looking forward to that kind of education for investors that communicates the basics of machine learning so that people can understand the main risks. All right, that's transparency. What is next? Let's see. Explainability. What is explainability? Ability to explain the rationale behind an action. In our case, that will obviously be an investment decision. And well, as we say here, objective is enable humans to understand appropriately and trust and effectively manage what artificial intelligence partners can do. And one kind of side note that I wanted to share here is that there's this inverse relationship, right? The more complicated a machine learning algorithm gets, the more difficult it gets when it comes to understanding it or being able to explain it. So that's something that we have to keep in the back of our heads if we are in this space. What's the problem with explainability? Well, it's that the systems are actually often quite complicated and therefore very difficult to explain. But what does that actually mean in financial markets? Think about this situation. Perhaps there's an investor that is really not interested in investing in defense, right? And the fund manager has also taken note of that and has a bit of a note and says, yeah, we have to impose certain constraints for this particular portfolio, excuse me, for this investor because he's not into the defense sector. But then think about some act of war, some fat tail event, perhaps similar to September 11, 2001, where the algorithm really realizes that because of this fat tail event, that is arguably an act of war, shorting airline stocks is a really good idea because that gets us the best profit, right? So we don't know how an investor's moral compass actually works, right? But this kind of situation may or may not be acceptable to that investor, right? Because airline stocks are obviously not, defense contractors, but the fact that the algorithm takes profit based on this war kind of situation, we don't know whether that's really in line with what they thought of. So what do we recommend to deal with this? Basically, what we're saying is we need to stress test these algorithms on a very regular basis to understand their behavioral patterns. And we need to do that, including fat tail events, because we don't have many fat tail events, which makes it very difficult to predict how the algorithm is going to react in these events where we don't have many observations that they could have learned from, right? So that is very important. As we said earlier, we shouldn't overdo it. Humans also make mistakes, and it is not fully explainable what humans do. Think about all of these rogue traders that sat in, I don't know, UBS and SocGen. There's a moment in time where lots of people were actually into rogue trading for some reason. And these rogue traders are also, committing actions that are not fully explainable. So that we have to accept that there's a residual risk that things can go wrong. Right? Often people forget about that. Okay, last one, accountability. Accountability is the ability to hold somebody accountable for their activities. And that also includes admitting that something went wrong, right? And obviously is very much related to explainability in the case of AI and finance. But I really want to think with you a little bit about what's the issue here. So accountability is sometimes not clear in this setting because people have interesting ideas about how to sue an algorithm, and then they get into this notion of, oh yeah, does the software developer need to take a trading exam now, or they want to grasp who can I take to court, right? And it's actually quite simple because remember this, AI is basically just a technology that enables the financial services provider, right? And therefore, the management that puts this technology to use is the one that will have to represent the entity and will have to go to court if need be, right? So it's very similar to if to a situation where somebody on the trading floor does something wrong. Who is the buy side client? Let's just think about this, right? There's a fund manager, and then there's its broker, and the broker has a person on its trading floor that does something wrong, books the trade the wrong way around or something. Fund manager loses money. Who are they going to hold accountable? Is it the trader? I don't think it's the trader. I think it's actually the brokerage entity, right? The company that is represented by principals that will then will have to take this accountability. Yeah. So an AI is nothing more or nothing less than a technology that is used by a financial services provider. Let's not get into this whole conversation about suing an algorithm, because it's not like that's not how regulation in finance works, right? Okay, to conclude, pace of technology is on this, accelerating curve. But I also believe that machine learning cannot really be considered a emerging technology anymore, because it's already being used in finance broadly. It's not free of ethical risks, so these need to be managed quite carefully. And therefore, it's essential to operationalize these ethical principles that regulators have put out, by thinking about how we can actually really apply them in our context in financial markets. And in our little book chapter, we suggest a bunch of these operationalizations. Of course, it's a conversation starter, right? You can see how we can do a lot more work in that space. But my recommendation stands: we should refrain from implementing more rigorous controls for AI than we do for humans. So that might be, stifling innovation. And I like to kind of close the more official part of this talk with a quote by my friend Henry Young, who has very extreme views sometimes on LinkedIn, but he's nevertheless very smart. He says, "I see no distinction between AI and people, since the latter are just biological AI." So with that, I really want to open up for questions, and thank you for attention so far. Looking forward to hearing more from you and understanding what you're interested in particular. I see that there's something on chat which I only have seen right now.
No, that's not for you, Dan. Don't worry.
Oh, okay, not for me. Okay, cool.
Well, thank you for this excellent presentation. This was very well summarized on the various key themes about ethics and AI. Now, I would like to kick off questions, and for people in the audience, please feel free to type your questions in the chat window, and time permitting, we'll try and answer as many as possible. The first question I would like to have for you, Dan, is now, when humans make mistakes, we kind of don't think that every human should be on par in terms of decision making at a particular level. We just basically say, okay, if a doctor makes mistake, we say, fine. I mean, every doctor is different in terms of interpretation. We don't expect all of them to treat patients at the same level, and we basically excuse them. But when machines make mistake, even a minuscule mistake kind of gets treated and gets onto the press and becomes a whole big deal. Now, how do you balance this notion of fairness when we treat fellow human beings and we kind of think that, well, humans make mistakes, that's acceptable, but when machines make mistakes, it's not acceptable, and we kind of, expect a higher bar for machines, or the highest bar for machines?
Yeah, very good question. Thank you. So as I tried to say earlier, right, I disagree with holding machines to a higher level of accountability or fairness, because I think in the end of the day, as we all know, they are working on a probabilistic basis, right? And we need to understand that, and then we will know that there will be errors that happen, right? And if we don't get comfortable with that, then we make wrong economic decisions. I have a dear friend who tried to implement machine learning in insurance, right? Mm-hmm. And he had a long conversation with all these actuaries, right? And they basically couldn't accept that the machine learning algorithm that was supposed to calculate underwriting type decisions had a I don't know what is it, some ridiculously low number, like 1% of the cases were basically assessed in the wrong fashion, right? Mm-hmm. And so even though they could have doubled the revenue, they didn't accept that, right? This is like a really large insurer. And what's interesting, sorry, a bit of a long story, but you'll see how it's quite relevant. What they did afterwards is they analyzed how often the humans, the actuaries, would get it wrong. And it was a really large number, like I mean, don't quote me, it was 25%, not 1%. So what does it tell us? It tells us that we need to understand machine learning better, because humans inherently fear what they don't understand. And that gets them to take the wrong decision. They accept making mistakes 25% of the time, let's say, as opposed to 1%, because at least they know how these 25% got there, but they don't understand the 1%, so there's less tolerance. And that is very dangerous, because you forgo huge revenue opportunity in this case, because you don't know enough. So that's why I think institutions like yours can play major part in trying to help and clean that up, because as more people understand the fundamentals of how machine learning works, people will get more comfortable with it. So that's one thing I want to say. And then the second thing I want to say, I think in financial markets it's slightly different than in medicine, right? I'm not a medical doctor, so I can't really comment on how much tolerance there is. But if you think about if you have like a Series 7 or a Series 65 or whatever it's called in the US, right? You're basically held to the same level of accountability, right? Because there's a rule book that says these are the things you can do, these are the things you cannot do. Pump and dump, bad, right? You lose your license, you can never practice finance anymore. So I think it's quite black and white. Yeah, and so that's maybe my thoughts on this topic.
Right. So kind of a follow-on question, right? So if you just go by I was having this discussion with someone saying, can we make the mistakes go to 0%? Right? And machines should be held to the highest standards, and we will not accept a machine to go beyond that. You cannot deploy a system which is 100% accurate for sure. Now the question is the same, similar fashion when you talk about machines making decisions, or rather humans making decisions. When humans make decisions, if something goes bad, that's why doctors have liability insurance. We don't intend to make mistakes, but if a mistake happens, we are covered, right? So do you have any thoughts, or have you tracked anything happening in the machine learning space wherein there is some kind of an insurance for, potential damage caused by algorithms? And if that becomes the norm, what does that mean to ethics in the context of, well, I have protection, so I can take more and more riskier decisions? And what does this mean to fiduciary responsibility?
Yeah, I mean, we can probably talk about this for a very long time. But if we zoom in on the pure sort of use of machine learning in the context of trade execution, right, and getting trades done in the markets, then I think there's no need for additional insurance on top of what already exists today, because principals of a brokerage firm will basically be the ones who will have to answer to the regulator or to their clients if something goes wrong. And I'm sure that there are basic insurance schemes that are being used, right? And basically all of this comes under operational risk, right? If you think about it. So I think there's no specific insurance required. And I would actually caution against it, because as you say, that would perhaps create some ill incentives where people go, well, but I'm covered anyway. And then I'll just go ahead and, do more experimental things that I always wanted to try out before. Yeah. So I think that is perhaps how I think about this.
Well,
and so actually
there are actually two questions I wanted to kind of ask. The first question is, I think it relates to some of your other areas of expertise, which is like blockchain. And I think there's a question on, we haven't seen many implementations outside of the cryptocurrency and smart contract space. So is it just that because blockchain is conceived as a write-only shared database? I think it's a little bit kind of borderline whether it's an ethics related issue, but maybe you can share your thoughts on that.
Yeah. Before I do that, Tree, if you don't mind, let me answer the question on the chat, because we've got
Sure.
one question that I just saw on the chat.
Okay.
Let me do that real quick. So
There's
the question
a
is,
chat
can
and there's also a question answer. So I think there are questions coming on both tracks. So yeah.
oh, okay, cool.
Yeah.
Okay, so this question says, can data quality check an answer for this question? Oh, okay. Performing QC, quality assurance, I assume that means checks on the financial model output. Yeah, you see, I think when we talk about how to stress test algorithms to see how they behave under different scenarios, then I think that is a very good thing. So I would agree that, you know, this is a very good question, or a very good pointer, because the more we understand how the algorithm behaves, the better we can risk manage it, right?
Mm-hmm.
I do think that we have this inherent issue with not having enough fat tail events in the history of finance to try these things out, which is why I think I'm going to attend the session next week on synthetic data, because that's kind of the solution. You know, how do you create data that lets you play with these different scenarios that we have? So I think there's a very good point that you're making there, and to some extent, I think that would definitely help. Yeah.
Cool. So, and this is again a little bit borderline philosophical question. So, you know, if you look at, like, you know, human behavior, right? So you have ignorance, and you have negligence, and then you have maleficence, right? So you're kind of, you know, you have really smart people trying to do really smart things, but then you have people who don't realize that it's a mistake and they're just doing it because that's the extent to which they do things, right? What do you think about, you know, how when we kind of building in intelligence into algorithms, you know, where do we stand? Because we are kind of giving it how people have behaved in the past. And if we look at real data to train real algorithms, so you have a whole spectrum of these historical use cases. And in ways, we are perpetuating bias, we're perpetuating some of these aspects through our behaviors, and we're training algorithms to be more human-like, which involves gradations of all these three, right? You know, Halloween happens and I steal candy from my daughter, and that's maleficent. But I mean, you know, but again, in the big scheme of things, you know, you have, you know, different parties getting affected. So what do you think about, like, how should machines, like, it should be like this Uber standard wherein this should be like the, you know, like the purest of all things, right? But how do we train it to be that way?
I think, I mean, this whole bias conversation is a very huge conversation, right? And not so much in, maybe also in financial markets, but also in consumer setting, where people think about, you know, is it fair to use this kind of data, and then somebody comes from a rough neighborhood and that's why they don't get credit, and all these sort of things, right? So I think the answer to managing some of these challenges is perhaps to have more abundant data, not necessarily more, you know, cleansed data from what we believe is kind of wrong, because sometimes there is a reason for bias, right? And you know, if you don't have any bias, then you can also not take good decisions, right? Or decisions that have turned out to be good in the past. So I think what's more interesting is to feed algorithms more data points, and I don't mean more observations, but I mean more features, to basically uncover how things came about in the past, right? And perhaps we can do that, and then also augment it with what I was saying earlier when we talk about fairness, where we have to delineate, right, what is illegal activity. And then even if somebody tried, you know, they can't do it, right? So today, if you sit in a bank and you try to do some sort of spoofing or something, then there is a compliance system that will, hit you on the finger and say you can't do that. So I think we need to treat them almost human-like to kind of avoid these issues that could lead to unfair behavior, right? The difference is, and I'm sure you would agree, that right now we cannot appeal to conscience, right? Because the concept of conscience is not quite there yet in machine learning space. So in the absence of conscience, where you can say, like Matt was saying, do the right thing, right? That doesn't cut it for machine learning. That doesn't cut it. So I think it needs to be delineated in a different fashion. What's very encouraging, actually, just to complement, is this whole movement of XAI, explainable AI, and how people actually work around, making things more transparent and more understandable to folks. So that's really good.
Yeah. So actually, there's a follow-on question from John Hill, the world's renowned expert on model risk management. One of the major challenges for validating machine learning models is the lack of explainability. Validation teams develop their own benchmark models to help validate champion models, which do not themselves have been validated. Would it be viable and ethical to use ML benchmarks to validate ML champion models and thus avoid the problem of transparency? What do you think?
Whew, that's like a derivative of a derivative of a derivative. It's a great question. First of all, is a really great question, right? Yeah, thank you. I think I haven't really thought about this, to be frank. I couldn't see why not in the first place. My question would be and now I need to delineate between the different derivatives. So if we have enough observations and enough data on the champion model level, right, then perhaps machine learning can do a good job. But it's not something that I have explored in detail, so I'm on thin ice here. So that's why I think John has asked a really good question.
John always asks really good questions.
Yeah. Oh, I love it. And then possibility of collusion. Yeah. So in my mind, collusion is one of those things that is a rogue behavior, just like a pump and dump scheme, right? That a machine learning algorithm could explore. So that's where perhaps the delineation topic comes in again. But wow, you gave me something to think about, John. So thank you for that.
Yeah, you'll be awake all night. I hope not, but so maybe we should end up with like one last question I was like itching to ask. So there's always this thought about how much of it should be self-policing and how much of it should be regulation, right? So you're kind of going with this whole network spoofing. You have something which says don't do it, but again, we have traffic laws too. And the laws explicitly say you can't go above 60 and people still go. And some of them don't get caught, some of them do get caught. When they're caught, they are penalized, right? And how do we regulate AI, when we think about defining all the parameters on it which it should operate? And when I'm kind of thinking, because, when we look at AlphaGo, which beat humans, right? Like, it's the best algorithm out there in terms of Go. But then the comment made by Isidore was the moves were not human-like, right? And what do you think about like AI? Like we can think about like, okay, do not do this, but what in case there are moves which are not human-like, and where do you draw the boundary of where it should be like, well, this is not ethical, I'm not going to do it, I'll self-police myself, versus, well, this is the smartest thing the algorithm came up with, and it's not my responsibility to take ownership of what an algorithm came up with.
Yeah. I mean, that is a very good question. And I think it kind of opens up to the whole topic of, is being compliant the same thing as being ethical, right? And that is, leave AI aside, that is already a very complicated question to answer. because you know, some things might be allowed by the regulator, and then some people might still think that they are unfair, or you know, they, you know, for example, there are proponents of you know, there are people who say high frequency trading is very unethical, right? Because you're exploiting that a privileged access to information, and then you know, that costs other people money that don't have this advantage, right? So from that angle, you can easily say that basically the rules or the regulation are the only thing that counts, right? And you could say whatever is allowed, and then that's as far as I go. And if I don't break any rule, then I've done it well enough. Or you could take the other stance and say, no, we need to think about these things more fundamentally, and then perhaps amend our regulation as we find out about these non-human-like behaviors, right? But that is a, you know, you could write a book about that alone, because there's it's quite nascent, right? These unhuman-like moves haven't been explored in detail to see whether there should be a change in regulation. And then we would have to map that back to some of the principles that we discussed today to see how that actually affects other market participants, right? So very, very interesting area.
Cool. So we'll leave it at that for now, Dan. This was an absolute pleasure. I wish we could continue the conversation. I hope we have not, you know, intrigued you enough to have you spend all night in Singapore thinking about these important questions. I think you should get some more sleep, and you can think about these big questions tomorrow morning.
Thank you.
We will continue the discussion, and next week, as Dan was mentioning, we're going to have Steven Jansen do a tutorial on how do we generate synthetic data with some of the models out there. And for people who are interested in continuing the discussion, connect with us on Quant University's YouTube channel or LinkedIn channel or any of the other social media channels which our marketing folks are putting together. And also join us at the Winter School. We are offering multiple courses so that you can not only just listen to these conversations, but also get engaged and kind of understand the core underlying algorithms which are driving all these innovative changes which are happening in the world. So let's continue the discussion online. And thanks again for attending. And I wish you all a very wonderful rest of the week. Thank you very much. And thanks again, Dan, and have a good night.
Thank you. Bye-bye. Bye-bye
Okay,
from Singapore. Bye-bye.